Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, March 14th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, who will step up and prevent global debt refinancing air pocket? Our answers are China's February credit data affords us an opportunity to shine a bright light on global liquidity dynamics in a year that requires a significant acceleration in global liquidity to prevent a destabilizing collapse in risk asset valuations. This is due to the significant acceleration in global debt refinancing demand, the fastest in a decade. If global liquidity, which is shorthand for global investor balance sheet capacity, does not expand materially in the coming months, there will likely be a global debt refinancing air pocket as global capital allocators demand lower valuations, higher yields, wider credit spreads, and more favorable terms to roll over existing debt obligations. In fact, it could be argued that the global debt refinancing air pocket we've been warning about for several quarters has commenced already. If so, that means the risk appetite of global capital allocators is already being curtailed by near unprecedented policy uncertainty and President Trump's adopting of our strategy to kitchen sink the U.S. economy. It may be the case that a weak dollar correlates with global capital destruction initially before ultimately providing a tailwind to global liquidity by giving foreign central banks confidence to ease aggressively and supporting the growth rate of global household savings, corporate profits, and trade. It may also be the case that the space between phase one and phase two of this process is the global debt refinancing air pocket that we've been warning about. With the global private sector likely pulling back amid slowing growth, declining confidence, and plunging asset values, and global trade likely about to contract sharply due to the trade war President Trump started, we need a central bank to step up and materially expand its balance sheet soon. Unfortunately, we have yet to see evidence of this bullish dynamic. President Trump will force the Fed's hand regarding QE eventually. That said, hoping for Jay Powell to supply the Trump administration with liquidity on a proactive basis is counter to the reactive nature with which the Fed has historically supplied liquidity. Transitioning to our 42 macro dashboard, as always, we'll wrap up the question from our community. This was not so much a question, just a comment. It says, Darius, these emails make my day. It says, received this email from my client on Tuesday. Quote, wow, you got my money out just in time. Thank you. All credit goes to KISS and DD and 42 Macro. So I just want to say thank you for the kind feedback. We continue to get a tremendous amount of really wonderful feedback from our thousands of clients around the world that are using our institutional grade risk management overlays, KISS and Dr. Mo, to help manage their asset allocation and portfolio construction. They've been having great results for years and they continue to have great results. And so I challenge you, if you've been listening to me talking these macro minutes every day and you're not paying attention to our KISS and Dr. Mo signals, to at least check them out because I do think they can help improve the results that you're experiencing in your own portfolio. So we'll wrap it up there. Darius here presenting our macro minute for Friday, March 14th, 2025. Everyone have a wonderful weekend. We'll catch you back here on Monday. Cheers.